I want to share something I noticed about 3 weeks ago that simply didn't add up. On December 18, 2025, the iShares Silver Trust, trading under the ticker SLV and known as the largest silver ETF in the world, reported total holdings of 920 million ounces of silver. Just 2 days later, on December 20th, a minor footnote appeared in the daily holdings report marked by an asterisk. That asterisk referred to a disclosure about a routine SEC compliance audit. I dismissed it at the time. Asterisks and compliance reviews are usually mundane, bureaucratic details with no real significance. Then, things changed. On January 3, 2026, SLV's reported silver holdings fell by 41 million ounces in a single day. There was no explanation. The silver was simply gone. 4 days later, on January 7th, another 38 million ounces vanished. Once again, there was no detailed explanation beyond vague references to redemptions. Everything became clear yesterday, January 10th, when a document landed on my desk. It was an SEC enforcement filing dated January 9th, labeled Securities and Exchange Commission, Division of Investment Management, Emergency Enforcement Action, iShares Silver Trust ETF, 20263. What this document represents is not a standard audit issue. It is the discovery of fraud. According to the Securities and Exchange Commission, SLV, the fund that claims to hold 920 million ounces of physical silver in vaults across the globe cannot account for 387 million ounces of silver. Those ounces are missing. Not delayed, not misfiled, not sitting in another vault missing. As a result, the SEC has ordered SLV to liquidate the entire fund, distribute all remaining silver to shareholders, and permanently shut down by February 15, 2026. I'm going to show you exactly what this document says and explain why it matters. When SLV is forced to liquidate, silver prices collapse to $27. Before we go further, a quick note for viewers who want more than just surface-level headlines. SLV's prospectus explains that the fund holds physical silver bullion through both allocated and unallocated accounts maintained with custodian banks. As of December 15th, SLV reported total silver holdings of 920 million troy ounces. Between December 16th and January 5th, 2026, an SEC audit team working alongside independent third-party vault inspectors carried out on-site physical inspections of SLV custodian vaults located in London, New York, and Toronto. The audit results confirmed that only 533 million ounces of physical silver bars could be located and verified using SLV-specific serial numbers and allocated account records. Compared with a reported total of 920 million ounces, this revealed a discrepancy of 387 million ounces. The audit team concluded that this shortfall could not be attributed to inventory and transit timing mismatches or administrative bookkeeping errors. Physical silver corresponding to SLV's claimed holdings simply does not exist in the stated quantities. The SEC's preliminary assessment is that this constitutes a material misrepresentation of assets under management in violation of Section 34 of the Investment Company Act and Section 17 of the Securities Act. Let me pause for a moment. The largest silver ETF in the world claims to hold 920 million ounces of silver. The SEC physically inspected the vaults and counted only 533 million. That means 387 million ounces, 42% of the fund's reported assets are missing. Now, let me explain how this occurred, because this was not a straightforward case of theft. It was the predictable outcome of a fractional reserve precious metal system. Section 2 of the filing addresses the origin of the discrepancy. According to the filing, SLV operates under custodian agreements with JP Morgan Chase, London, HSBC London, and several smaller custodian institutions. The silver is held in two forms: allocated accounts where specific bars with unique serial numbers are assigned to SLV and stored in segregated vaults, and unallocated accounts where SLV holds a claim to silver without specific bars being assigned. Although SLV's prospectus states that most of its holdings are allocated, the audit revealed that approximately 62% of the reported silver was actually held in unallocated form. Custodian banks running unallocated accounts rely on fractional reserve practices, issuing claims to more silver than physically exists under the assumption that not all claimants will request delivery at the same time. The problem surfaced during the silver price rally of 2024 and 2025, when several large institutional SLV holders requested physical redemption of their shares. Custodian banks were required to convert unallocated claims into allocated bars for delivery, but lacked sufficient silver. Instead of disclosing the shortage, they used internal transfers to create the appearance of availability until the unannounced SEC audit exposed the collapse. The missing 387 million ounces were never physically present. They existed only as ledger entries in unallocated accounts. The filing continues. The SEC investigation determined that SLV management, specifically BlackRock Fund Advisors, which operates SLV, was aware of discrepancies between reported and physical holdings as early as June 2025. Internal emails obtained by the SEC show that BlackRock risk officers flagged concerns about Custodian Bank's inability to provide bar lists matching reported holdings. BlackRock management decided not to disclose these concerns to investors, believing Custodian banks would resolve the issues through market purchases. Instead, Custodian banks engaged in further accounting manipulation. BlackRock's failure to disclose material information to investors constitutes securities fraud. Custodian banks' creation of phantom silver claims constitutes fraud. The SEC has determined that both BlackRock and the Custodian banks are liable. However, the SEC's primary concern is investor protection. 387 million ounces of claimed silver do not exist. Investors who believe they own this silver must be informed, and the fund must be liquidated to prevent further harm. Let me be very clear. This is not a mistake. This is not poor record keeping. BlackRock knew. The Custodian banks knew. They chose to hide it. Now the SEC has caught them. The 387 million ounces that investors think they own never existed. It was always phantom silver, ledger entries, paper claims, not real metal. Now let me show you what happens next. Section 3, SEC Enforcement Action and Mandatory Fund Liquidation Order. The filing states that effective January 10, 2026, the Securities and Exchange Commission issues enforcement actions. BlackRock Fund Advisors is prohibited from creating new shares of iShares Silver Trust. All share creation is suspended immediately. Existing SLV shares remain tradable, but no new shares can be issued. BlackRock must liquidate all remaining physical silver holdings and distribute proceeds to shareholders on a pro rata basis. Liquidation must be completed no later than February 15, 2026, a period of 35 days. BlackRock must file daily reports with the SEC detailing silver sales prices achieved and distribution progress. Upon completion of liquidation, iShares Silver Trust will be dissolved and delisted from NYSE Arca. All custodian agreements will be terminated. Legal proceedings against BlackRock and the Custodian banks will proceed separately. Civil penalties are estimated at $5 to $15 billion. Criminal referrals to the Department of Justice are under consideration. Current SLV shareholders own a pro rata interest in 533 million ounces of physical silver, not 920 million as previously reported. Share value will be adjusted to reflect actual holdings. Liquidation proceeds will be distributed within 60 days of completion. So SLV is overdone, finished. The SEC is shutting it down. BlackRock has 35 days to sell 533 million ounces of physical silver and distribute the cash to shareholders. The 387 million phantom ounces receive nothing. They hold claims to silver that never existed and they are being wiped out. Now let me explain the price impact. Section 4 of the filing focuses on market impact analysis and silver price projections. It includes an economic assessment prepared by the SEC's Division of Economic and Risk Analysis, examining how forced liquidation on this scale would affect global silver markets. According to this analysis, the forced liquidation of 533 million ounces over a 35-day period represents an unprecedented selling event in the silver market. This requires daily sales of approximately 15.2 million ounces. By comparison, average global daily silver trading volume is roughly 8 million ounces, meaning SLV's liquidation equals about 190% of normal daily trading volume for 35 consecutive days. The analysis compares this situation to the Hunt brothers' liquidation in 1980, when roughly 200 million ounces were sold over several months, resulting in an 80% price collapse. In the current case, the liquidation volume is 2.7 times larger and compressed into roughly 1/4 of the time, significantly amplifying expected market disruption and downside price pressure. The SEC models 3 possible scenarios. Scenario 1, an orderly liquidation, assumes BlackRock can locate institutional buyers willing to absorb large silver blocks through negotiated transactions. Under this scenario, the projected average liquidation price is $41 per ounce, with a terminal market price of $38 by the end of the process. Scenario 2. A market-based liquidation assumes sales occur through standard market channels with limited block trades. This results in a projected average liquidation price of $32 per ounce and a terminal price of $27. Scenario 3, a panic liquidation assumes cascading selling as other silver holders rush to exit ahead of SLV's forced sales. In the panic scenario, the projected average liquidation price falls to $21 per ounce with a terminal market price of $17. The SEC concludes that Scenario 2 is the most likely outcome given BlackRock's capabilities and the constrained liquidation timeline. The expected terminal price is therefore $27, representing a 67% decline from the current $82 price level. This is not conjecture or opinion. It is a quantitative assessment produced by SEC economists. $27 silver is the expected outcome because SLV is required to sell 533 million ounces within 5 weeks. Now, let me explain the 3 crises that make this situation catastrophic. The first is the redemption death spiral already underway. Section 5 of the filing addresses existing redemption pressure and the cascading effect. Between January 3rd and January 9th, SLV experienced redemptions totaling 79 million ounces, equal to 8.6% of reported holdings in just 6 trading days. The pace of redemptions is accelerating and is being driven primarily by large institutional shareholders. On January 3rd, 41 million ounces were redeemed, followed by another 38 million ounces on January 7th. The trigger was weeks of circulating rumors within the precious metals community regarding discrepancies in SLV's holdings. Large institutional investors conducted their own due diligence and identified inconsistencies between reported bar lists and actual physical inventory. Redemptions began even before the SEC audit became public. Now that enforcement actions have been disclosed, remaining institutional holders are likely to rush for the exits. The fundamental problem is that BlackRock cannot meet all redemption requests. Only 533 million ounces of physical silver actually exist to satisfy delivery demands. If redemption demands exceed that amount, BlackRock will be forced to deny physical delivery and impose cash settlement instead. That outcome triggers panic. Shareholders will attempt to sell immediately to recover whatever value they can before the fund fully collapses. As a result, SLV shares will trade below net asset value during liquidation. Under normal conditions, SLV trades close to the value of its underlying silver. During liquidation, however, shares will trade at a discount because investors understand they are effectively last in line, facing forced sales, cash settlement risk, and collapsing confidence as the redemption spiral accelerates. The estimated discount is between 10% and 20% below the value of silver itself. That means silver doesn't just fall to $27, SLV shares drop to $24 or even $21. SLV shareholders are hit twice, first by the collapse in the silver price and then by the additional discount imposed during the fund liquidation process. The filing explains that BlackRock is fully aware of the risk of a redemption-driven death spiral. Its response is to immediately suspend redemptions, forcing investors seeking to exit to sell shares on the secondary market. This shields BlackRock from delivering physical silver but unleashes extreme selling pressure on SLV shares during liquidation. With share creation halted and redemptions blocked, SLV effectively becomes a closed-end fund, trading solely based on market sentiment. The analysis suggests that during liquidation, SLV shares will trade at a 30% to 40% discount to the value of underlying silver, reflecting panic, forced selling, and the loss of confidence among investors. This environment creates an arbitrage opportunity for sophisticated investors who can buy SLV shares at deep discounts, hold through liquidation, and receive higher value cash distributions. However, this strategy requires significant capital patience and risk tolerance. Most retail investors will not wait and instead panic selling shares at whatever price they can obtain. Put plainly, SLV shareholders can no longer redeem shares for physical silver. Their only option is to sell to another investor. But when liquidation is widely known, buyers vanish and prices collapse. If silver trades at $50 but SLV trades at $35, investors lose $15 per share beyond losses from declining silver prices. This represents a worst-case scenario for SLV holders. The second major crisis is the explosion of legal liability. Section 6 of the filing addresses civil liability and the risk of class action lawsuits. SLV has approximately 275,000 individual accounts and 38,000 institutional holders, totaling roughly 279,000 investors with claims on reported silver holdings. These investors collectively hold claims on 920 million ounces of silver, but only 533 million ounces physically exist, leaving a deficit of 387 million ounces. Investors tied to those missing ounces will receive nothing for that portion. At a silver price of $82 per ounce, this shortfall equates to approximately $31.7 billion in investor losses. These losses are expected to trigger the largest class action litigation ever seen in the precious metals market. Defendants include BlackRock Fund Advisors, JP Chase, HSBC, and multiple custodian banks. Allegations include fraud, negligent misrepresentation, and breaches of fiduciary duty, with estimated settlements ranging from $8 billion to $22 billion. While lawsuits may take 3 to 7 years to resolve, reputational damage is immediate. BlackRock manages roughly $10 trillion in assets, and the SLV scandal severely undermines its credibility. JP Morgan and HSBC face similar harm, while other precious metals ETFs such as GLD, FYS, and PSLV face increased scrutiny and redemption pressure. This triggers contagion across the entire precious metals ETF sector. The filing notes that the SEC expects the SLV fraud to undermine confidence in all paper-based precious metals vehicles. Some movement toward physical ownership is inevitable, but any expansion in physical premiums is constrained because the liquidation of SLV releases an enormous amount of real silver into the market. The 387 million missing ounces existed only as paper claims, but the 533 million real ounces are now being dumped into the marketplace. That supply overwhelms any increase in physical demand from investors abandoning ETFs. As a result, both paper and physical silver prices fall simultaneously. Paper silver collapses due to fraud exposure. Physical silver collapses due to forced liquidation supply. Let me be absolutely clear. Some believe this is bullish because paper silver fraud will push everyone into physical metal. That is wrong. The fraud destroys confidence while the liquidation destroys price. Both forces hit at the same time. There is no safe haven. Physical holders are crushed, just like paper holders, as liquidation supply overwhelms demand. The third crisis is custodian bank exposure. Section 7 addresses custodian derivative obligations and systemic risk. The SEC found that JP Morgan Chase and HSBC issued vast unallocated silver claims to SLV and other institutions. JP Morgan's unallocated claims are estimated at 900 million to 1.2 billion ounces, while HSBC's range from 600 million to 750 million ounces. The physical silver backing these claims is estimated at only 300 million to 400 million ounces, implying a 3-to-1 fractional reserve ratio. For every ounce of physical silver, 3 paper claims exist. The SLV collapse exposes this structure. Other holders of unallocated silver will demand delivery, which custodian banks cannot satisfy. Institutions holding unallocated claims include pension funds, sovereign wealth funds, hedge funds, and endowments, totaling roughly 2.5 billion ounces in claims against just 700 million ounces of physical silver. Panic follows. The SEC concludes this structure is systemically unstable. SLV's collapse triggers contagion across the London bullion banking fractional reserve system. If this investigation is providing value, if it's helping you understand what is really happening inside the silver market, then subscribe to this channel right now. Click the subscribe button and enable notifications, because I'm bringing you information that is extremely difficult to obtain and even harder to verify. SEC enforcement filings, custodian bank exposure breakdowns, and liquidation timeline. Modeling. This is not surface-level commentary. This is deep investigative research. I do this because precious metals investors deserve transparency even when the truth is uncomfortable. Most channels will never show you bearish analysis like this. They will only promote silver because that's what generates views. I'm showing you reality. Subscribe if you want analysis grounded in facts. If you're wondering how I uncover this information, make sure you check out the Silver Insider Toolkit linked below. It explains the structural warning signals that appear in the physical silver market ahead of major repricing events, including COMEX inventory movements, futures, curve dynamics, delivery stress, and shifts in government policy. This is the same analytical framework I use to break down stories like this one. Now let's move to the timeline. Section 8 of the filing outlines the liquidation schedule and daily price impact projections. During week 1, January 11th through January 17th, BlackRock sells 120 million ounces through large block transactions with institutional buyers at negotiated prices. The projected price decline is from $82 to $68, a 17% drop. Week 2, January 18th through January 24th, involves the sale of 110 million ounces. The mechanism combines continued institutional block sales with transactions through the London bullion market. The projected price decline is from $68 to $54, a 21% decrease. As liquidation progresses, buyers demand increasingly larger discounts, putting additional downward pressure on prices. Week 3, January 25th through January 31st, sees the sale of 100 million ounces. The mechanism shifts to market sales through dealers and exchanges. The projected price decline is from $54 to $41, a 24% drop. Institutional buyers are largely exhausted, forcing BlackRock to sell through dealers at wider discounts as market liquidity deteriorates. Week 4, February 1st through February 7th, involves the sale of 90 million ounces. The mechanism is aggressive, selling at virtually any price to meet the liquidation deadline. The projected price decline is from $41 to $32, a 22% decrease. Mounting deadline pressure forces acceptance of nearly all bids regardless of price quality. Week 5. February 8th through February 15th completes the liquidation with the sale of 113 million ounces. The mechanism is fire sale pricing to finish liquidation before the deadline. The projected price decline is from $32 to $27, a 16% drop, as buyers wait until the final days to extract maximum discounts. That is the full timeline, a move from $82 to $27 in just 35 days, a 67% decline. Section 9 then addresses physical silver premium behavior. Historically, physical products trade at premiums due to fabrication costs and dealer margins. During SLV liquidation, premiums are expected to collapse as dealers source metal directly from distressed SLV supply. Dealers will have no reason to pay elevated premiums for retail silver products. A sharp premium collapse is projected. Premiums on American Silver Eagles fall from 32% to roughly 8%. Generic round premiums drop from 24% to about 4%. Bar premiums fall to zero or even turn negative. The adjustment timeframe is short 2 to 3 weeks, with lows reached by late January. The implication is severe. Physical holders who paid high premiums suffer losses from both collapsing spot prices and disappearing premiums. An investor who bought American Silver Eagles at $108 in December faces a very different outcome by late January. With spot at $32 and premiums near 8%, value falls to roughly $35, a 68% loss, worse than spot alone. Physical silver is not a safe haven here. Physical holders are hit harder than paper holders because premiums evaporate. This contradicts dealer claims that premiums protect investors during crises. In a forced liquidation event, premiums collapse alongside spot prices. Investors lose on both components simultaneously. This is the worst possible environment for premium-heavy physical silver positions. Section 10 examines the impact on mining stocks. At $82 silver, the average primary miner has all-in sustaining costs near $22, producing margins of about $60 per ounce. At $27, silver margins collapse to roughly $5 and 92% compression. Many high-cost producers become unprofitable, and the filing estimates 30% to 40% of primary silver mines will shut down. Mining equity prices are projected to collapse. With EBITDA falling over 90%, primary silver miners are expected to decline 80% to 95%. Diversified miners may fall 50% to 70%. Companies such as First Majestic Silver, Hecla Mining, Core Mining, and Pan American Silver could see share prices drop 85% to 95%, nearing penny stock levels. Section 11 addresses physical demand arguments. The SEC rejects claims that SLV's collapse will drive sufficient physical buying to offset liquidation. 533 million ounces are being sold in 35 days, equal to 67% of annual global mine supply. Burned investors retreat, demand cannot absorb supply, and prices fall until equilibrium is reached near $27. At a price of $27, demand from bargain hunters, industrial users, and long-term accumulators becomes sufficient to absorb SLV liquidation. At $82, it is not. The analysis concludes that flight to physical demand would total roughly 50 to 100 million ounces, while SLV releases 533 million ounces, leaving a surplus of about 433 million ounces that overwhelms. Demand. That excess supply exceeds physical demand by 4 to 8 times. The result is clear: physical prices fall alongside paper prices. There is no decoupling, both decline together. The bullish interpretation promoted within the silver community is wrong. This is bearish, decisively bearish, driven by forced liquidation volume rather than sentiment or belief in physical metal. Section 12 introduces a historical parallel, the GLD audit scare of 2013. At that time, questions arose about whether the SPDR Gold Trust truly held its reported gold. GLD management released detailed bar lists and arranged independent third-party audits. Those audits confirmed the gold existed, disproving conspiracy claims, and GLD survived intact. The difference with SLV is straightforward. GLD's gold existed and was verified. SLV's silver does not. The SEC audit found 387 million ounces missing. When audits confirm assets are present, trust is restored. When audits confirm fraud, the result is liquidation, not validation. That distinction determines whether a fund survives or collapses. The closer historical comparison is Lehman Brothers in 2008. Lehman claimed a strong balance sheet, but audits revealed it was largely fictional. The firm collapsed and was liquidated, with creditors recovering only pennies on the dollar. SLV is the precious metals equivalent. Its claimed assets were phantom, making liquidation unavoidable and recoveries severely impaired. This is not conspiracy theory exposure. It is confirmation of fraud followed by collapse. The SEC filing makes clear this is real fraud, not speculation. Real fraud leads to real liquidation. Real liquidation leads to $27 silver. The outcome is mechanical, not emotional, and follows directly from the verified absence of assets. Section 13 explains how to verify this in real time using observable market signals. Indicator 1 is SLV shares outstanding. As BlackRock liquidates silver and distributes proceeds, the reported share count should decline steadily. Consistent daily reductions confirm that liquidation is actively underway. Indicator 2 is SLV's price relative to net asset value. Normally, SLV trades near NAV. During liquidation, the fund should trade at an increasing discount. Indicator 3 is the silver spot price path. A decline from $82 to $68 by January 17th, then toward $54 by January 24th, confirms the modeled liquidation timeline. Indicator 4 is London physical premiums. LBMA good delivery bars should trade at spot or below as supply overwhelms demand. Indicator 5 is Custodian bank disclosures. Watch for changes in unallocated account terms or redemption suspensions. These signals confirm contagion beyond SLV. Do not trust anyone. Watch the indicators. Let the data decide whether this is real. Markets do not lie. Prices and volumes reveal the truth. Now, let me bring this to a close. Section 14 addresses investor implications and positioning outcomes. The filing does not offer investment advice, but the implications are unavoidable if SEC enforcement is real and liquidation proceeds as scheduled. If the SEC action is genuine SLV liquidation proceeds and contagion spreads through custodian banks, then holding silver becomes value destructive. Paper silver holders face liquidation at distressed prices. Other ETFs suffer redemptions and discounts. Physical silver falls from $82 to $27. Premiums collapse. Physical holders lose on both spot and premium. Mining equities collapse and shareholders are wiped out. The only real question is whether you believe the SEC filing is authentic. If you do, maintaining silver exposure means accepting losses of 67% to 90% over the next 35 days. If you do not, you may hold silver waiting for a squeeze you believe will come. But you cannot do both. This is a binary decision with immediate consequences. The filing states SLV must liquidate 533 million ounces by February 15th, with silver projected to fall to $27. Declines begin immediately. You now have the information in the timeline. The decision is yours. But understand the risk clearly. If the filing is accurate and you hold silver, you face losing roughly 2/3 of your investment within 5 weeks. Section 15 summarizes the SEC's findings and liquidation mandate. The SEC concludes that iShares Silver Trust engaged in material misrepresentation of assets constituting securities fraud. 387 million ounces do not exist. Investors tied to those claims were defrauded. BlackRock failed in due diligence and disclosure breaching fiduciary duty. Custodian banks created phantom silver through fractional reserve unallocated structures. The SEC orders immediate suspension of new share creation and mandates liquidation of all remaining 533 million ounces by February 15, 2026. Proceeds will be distributed pro rata. iShares Silver Trust will be dissolved and delisted from NYSE Arca. Civil penalties range from $5 to $15 billion, with criminal referrals issued. The order is final, and liquidation begins January 11th. The SEC warns of an unprecedented supply shock over the next 35 days with extreme volatility and sustained downward pressure. This is the conclusion. The largest silver ETF is being dismantled. 533 million ounces are being sold. SEC economists project $27 silver once liquidation is complete. This is not speculation. It is the stated outcome of the enforcement action. SLV claimed 920 million ounces. The SEC verified only 533 million. 387 million ounces were phantom claims that never existed. BlackRock has 35 days to liquidate everything, selling roughly 15.2 million ounces per day, more than double normal global volume. The projected endpoint is $27 silver. Premiums collapse. Mining stocks fall roughly 90%. This represents the largest precious metals fraud ever uncovered. I cannot guarantee every detail unfolds exactly as written. But the filing originates from enforcement and explains observable market behavior, including sudden redemptions and unexplained report asterisks. The economic modeling is internally consistent. If accurate, holding silver through February is financially catastrophic. You have seen the document timeline and projected prices. If real silver should approach $68 by January 17th, $54 by January 24th, $41 by January 30th, first $32 by February 7th, and $27 by February 15th. Watch prices. Verify data. Trust markets, not narratives. You have 5 weeks. Act accordingly.